from Paris, good evening in Asia, and good morning in the Americas. And welcome and thank you for joining the International Energy Agency organized webinar on the IEA's Energy Efficiency Market Report 2015. My name is Sarah Pasquier, and I am the moderator for this session. Together with me are Kamel Ben-Nasser, IEA Director of Sustainable Energy Policy and Technology, who will open the webinar shortly. Philippe Benoit, IEA Head of the Energy Efficiency Environment Division. He is responsible for the production of this report. Sam Thomas, Senior Program Manager in the Energy Efficiency Unit, who will present the key findings today. And Tyler Bryant, Energy Analyst in the Energy Efficiency Unit and the Project Manager of the Energy Efficiency Market Report. The webinar presentation will take approximately 25 minutes. We warmly welcome your questions and comments at the end of the webinar. Let me now go through the setup of the webinar so you will know how you can participate in today's session. On the screen, you will see an example of the attendee interface. You should see something like this. You have joined today's webinar listening through your computer speaker system by default. If you would like to call in using the telephone, select Use Telephone on the audio panel. The dial-in information and access code will then be displayed. You also have the ability to ask questions using the Questions pane. Simply type in your question and click Send. As I mentioned earlier, we will take questions at the end of the presentation. Please note that we are recording this webinar and will make a link available. Let's now proceed with the introduction by Mr. Ben-Nasser.
Thank you very much, Sarah, for the introduction and the instructions. And thank you all for attending at different times of the day. I would like first to thank all the contributing parties from several countries and organizations for either their financial support or their support by provision of data. The International Energy Agency has had a long history of producing market reports on oil, gas, coal, and more recently renewables. But energy efficiency has remained a hidden jewel. It is a very important part of the energy landscape today, but there were not enough information available on this market. This 240-page report is a very strong contribution to advancing the knowledge in this sector. We have launched the first Energy Efficiency Market Report in 2013, and this is the third one in the series. Why did we launch that? First, we wanted to show the recent trends in efficiency. Second, the levels of investment in energy efficient technologies. And third, the characteristics of different markets across sectors and countries. The first market report that was published 2 years ago in 2013 laid the ground for the series. It introduced energy efficiency as the first fuel, given its contribution to meeting energy service demand. It also estimated the market size to be between $150 and $300 billion annually, and it also focused on the market for energy efficiency appliances, lighting, and ICTs. The second report in 2014 refined our estimate of market size to be about $300 to $360 billion, and it focused on the market for energy efficient land-based transport and developments in energy efficiency finance. Next slide. So this edition of the market report, a 240-page book, analyzed the returns to energy efficiency investments to both energy consumers and to wider society. The buildings energy efficiency market, which is growing in key jurisdictions, and the relationship between energy efficiency and electricity markets, which are evolving with shifts in demand. And Sam will present the key findings in a moment. Let's move to the next slide. The timing of this report is extremely important. As you all know, we are within a month and a half of a very important event here in Paris, which is the COP21. And the agency has been running a series of analyses in terms of scenarios for future energy demand and as well as emissions. So if we look at the two scenarios here, which is the 2DS scenario and the 6DS scenarios, the 6DS scenarios shows that the continuous increase of emissions to reach 56 gigatons of CO2, while the 2-degree scenarios goes down in emissions and to about 16 gigatons of emissions compared to the current level, which is about 34 to 35 gigatons of CO2. So in order to achieve the 2-degree scenario, a number of options are available that are complementary, and the 6 options, which include the nuclear, the power generation, the renewables, the end-use fuel switching, the carbon capture and sequestration, and the end-use fuel and electricity efficiency, contribute to reaching the 2-degree scenario, which has been put as a target on the negotiations. Among those wedges, 6 wedges, the most important one is actually the energy efficiency, and it's estimated that 40% of the emission savings between now and 2050 can come from energy efficiency. This is from our IEA scenarios. More recently, the agency has produced a report in June 2015, which has looked at what would happen if the countries meet their pledge, which are described in the INDC scenario. Essentially, the emissions will continue rising even with the pledges from the countries, and we have received today through the UNFCCC 120 countries pledges. That is not enough to meet the 2-degree scenarios. The report on climate change as part of the WEO has highlighted that if we want to still be in a position to meet the 2-degree scenario, we could actually, without a significant investment, and this is what we call the bridge scenario, reduce the emissions as early as 2020. Actually, the emissions will peak by 2020, and this is the yellow curve on this graph. In order to move from the INDC scenario to the bridge scenario, there are 5 wedges that are needed to be implemented, and out of these 5 wedges, the biggest one is the energy efficiency, which represents roughly half of it. Another one, which is related to the efficiency of generation of electricity, is actually the reducing the inefficient coal. And then a third one is the fossil fuel subsidy reform. If we look at the investments that are required for a 2-degree scenario, the amount of investment that this consistent has been estimated by the World Energy Outlook produced by the agency to be about $14 trillion as a cumulative investment in the next 20 years. Today, if we look at the running rates of investments, we are falling far short from that level of investment of the $14 trillion. So what we need to see is doubling from the investment from $300 billion per year today, which has been reported earlier, to $600 billion. This will be detailed by the next slides that will be presented by Sam to report on the energy efficiency market. Sam?
Thank you, Kamal. And that really sets the scene nicely for what I'm about to say about energy efficiency, the Energy Efficiency Market Report 2015. Energy efficiency has got a big role to play going forward. What this report really sets out is what's going on now in the market and what's been happening in the recent past. So just to start with a very high-level indicator, energy intensity, we see that since 2010, we've had improvements year on year since the turn of the decade, both in OECD and non-OECD countries, but we've seen a slowing pace of improvement over that time. Now, we're still waiting for all the data for 2014, but we do see that in the OECD, we've had a rebound in the rate of improvement in energy intensity. That's risen back to 2.3% in the most recent year, driven to a large extent by improvements in OECD Europe, where we've seen an annual increase in the rate of improvement to 5.5%. Now, that 2.3%, it's pretty good, but it's not quite reaching our SE for all target of 2.6% per annum, but it's looking like it's certainly within reach. Now, as I'm sure many of you on the webinar know, energy intensity doesn't equal energy efficiency. What we need to do is to decompose energy consumption into the various factors that influence it. And for IEA countries, we see that has energy efficiency not improved since 1990, and the structure of the economy had remained the same, but population had continued to grow as we've observed, and the economy had also grown as observed, then total final consumption, that's end-use energy consumption, would have been 30% higher than it was in 1990. And we call this the activity effect. But what we've actually seen is that total final consumption, or end-use energy consumption, rose until the mid-2000s, and since then has reduced back to close to 1990 levels. So what's caused this decoupling of GDP growth and energy consumption growth? Well, there have been changes in the structure of IEA economies, and that has had some impact. So what we've seen is some shifting of energy consumption from more to less energy intensive sectors on the industry side, and that's been particularly important actually over the last decade. However, energy efficiency has been a much more important factor in driving down demand. And in the report, we say that 2/3 of the downward pressure on demand has been driven by energy efficiency as a result of investments since 1990. So the avoided consumption from energy efficiency investments since 1990, we can see it's risen over time and the returns have accumulated. And we can see that on this bar chart here. Over the last few years, those investments have been delivering around 20 exajoules of avoided consumption per annum. And in 2014, that rose to 22 exajoules, or 520 million tons of oil equivalent for those who think in physical units. And that's a 10% increase on 2013. Now, even if you don't think in terms of million tonnes of oil equivalent, it's perhaps worth thinking about those 22 exajoules in terms of the amount of consumption that takes place in IEA member countries. That 22 exajoules is larger than the annual total final consumption of both Japan and Korea combined. But what does that mean in terms of the gains to energy consumers? Well, they've saved money. And we can see that on this chart here, which has broadly the same shape curve as we trace the impact of avoided consumption on end user bill savings. And we can see that in 2014, energy consumers in IEA countries saved around 550 billion US dollars, and that's more than the EU's total annual fuel import bill. And over the last 25 years, consumers have saved 5.7 trillion US dollars. Now, in this year's report, we look more broadly at some of the multiple benefits beyond simply the energy savings and their values to consumers. In particular, we focus on energy security, where domestically produced efficiency gains can substitute for imported fuels in meeting energy service demand, and on climate, where avoided consumption translates into greenhouse gas emissions savings. Now, to do that, we need to translate these 22 exajoules that we see on this chart here from end-use consumption, the total final consumption, to primary energy consumption, or total primary energy supply. And we can see there the 22 exajoules on the left split into the end-use fuels. And we can also see that the top bar there, electricity, is a particularly important part of our avoided energy consumption. Now, to turn that into primary energy, we need to split that out into the fuels that are used to produce that electricity. And because of the inefficiencies in production of electricity, we can see that we increase the volume of savings by over 50% when they're expressed in primary terms. So using those primary energy savings, we can draw some conclusions about some of the benefits to our IEA member countries. So on avoided imports, we find that IEA countries avoided 190 million tonnes of oil equivalent of fossil fuels, so natural gas, oil and coal imports in 2014. And that saved them 80 billion US dollars, boosting Germany's trade surplus by 12% and reducing Japan's trade deficit by 8%. And we see that for energy importers, domestically produced efficiency is substituting for imported fuels. And in doing so, energy efficiency is supporting energy security and improving those countries' macroeconomic outlook. On climate, we see that IEA member countries' emissions are now back down at 1996 levels. Kamal showed that, that when we look forward, energy efficiency is playing a major role in reducing emissions. Here we can show that energy efficiency has been a large part in the shift downwards in IEA member country emissions, and that without efficiency investments, estimated member country emissions would have been 870 million tonnes higher in 2014. Now, of course, it's very important to take account of cumulative emissions, and since 1990, over 10 gigatons have been saved in IEA member countries as a result of investments since then, almost a year of IEA energy sector emissions. And that's helping to make the 2 degrees target more achievable. Now, in the report, we also take a forward look into the medium term, and we're relatively bullish about the outlook for investment. We've seen strong policy developments that should drive action, particularly, for example, the EU Energy Efficiency Directive and the US Clean Power Plan, both of which have been introduced over the last year. We've seen the intended nationally determined contributions submitted to the UNFCCC that Kamal mentioned, all of which, either explicitly or implicitly, will be driving energy efficiency action. And over the last year, we've seen consumption subsidies cut in a number of jurisdictions, dampening the drop that we've seen in wholesale prices. Now, in the short term, we have seen some impacts on consumer behaviour, particularly in the passenger vehicles market, but certainly not universally. In Germany, even in the vehicles market, we've seen the efficiency of the new passenger vehicle fleet continue to improve in 2015. In the US, the oil price change has had more of an impact on end user prices. Unlike in 2009, when incomes fell along with oil prices, in 2015 we have seen increases in the share of light-duty trucks, dragging down the average fuel efficiency of the new vehicle fleet. However, what we can see here on the rest of this chart is the corporate average fuel economy target that stretches out into the medium term, and that should drive up investments in order that the US vehicle fleet can get back on to that efficient trajectory. However, there's one sort of caveat to that conclusion, and that's that if we do see continued low oil prices, that could ultimately weaken support for efficiency as pressure comes potentially on those CAFE standards as they become more difficult to meet. Now, the report moves down from that sort of bird's eye view to look at some sectors and some jurisdictions in more detail. This year, as Kamal mentioned, we're looking at the buildings market, and buildings obviously a very important market for efficiency. Buildings are responsible for more than 30% of final energy consumption globally. We looked at the market size and estimate it to be at around $90 billion US dollars, plus or minus $90 billion plus or minus 10 billion. Interestingly, 3 countries, the US, China and Germany, make up 2/3 of that global investment. One noticeable thing that we found when looking at the data was that investment was quickening. The US invested 1.9% of its total construction spending on efficiency in 2009. By 2014, that has increased to 2.4%. Similarly, in Germany, investment rates have doubled from 3% in 2009 to 6% of total construction spending in 2013. This and continued strong policy drivers lead us to project that the buildings efficiency market will continue to grow and reach $120 billion US dollars by 2020. However, that still falls far short of the estimated $215 billion US dollars needed to achieve the 2-degree scenario. We also wanted to look at how energy efficiency is impacting on the electricity system, knowing the importance of the electricity system for the low carbon transition. The trend for electricity consumption in IEA countries shows that growth has been declining in each decade with negative growth since 2010. What we wanted to better understand was the role of efficiency in this long-term trend. We estimate that efficiency improvements since 1990 saved 2,200 terawatt hours in 2014. Without those improvements, electricity consumption would have been 24% higher. Now, instead of that, since 2010, we've seen a 2% decline in electricity consumption, and without the efficiency investments, it would have been growing by 3%. So what does that mean for the electricity market? Well, it presents both a challenge and an opportunity for incumbent electricity utilities. It can destabilize some of the financials of the vertically integrated generators, but at the same time, it's offering new revenue streams from energy services. And this is something that we're seeing being taken up in both the regulated markets of the US and in the liberalized markets of the EU. Interestingly, efficiency also lowers the total investment needed to achieve renewable energy targets. For example, Sweden and Germany would have needed over 13,000 gigawatt hours of variable renewable energy to maintain the share of renewable generation had there been no efficiency improvements over the last 10 years. And that amounts to an additional 5 gigawatts of renewable capacity. Now, we've also done some detailed chapters on efficiency markets in 9 different jurisdictions, which we've grouped into 4 different themes. Now, in the interest of time, I won't go into too much detail, but just to say that we looked at 2 large energy exporters, Saudi Arabia and Russia, who are increasingly looking to efficiency to boost export volumes. We looked at 4 subnational governments and cities who are major enablers of energy efficiency markets, so Seoul, Tokyo, Paris and Massachusetts. We went to Latin America for the first time, looked at Brazil and Mexico, where energy efficiency is supporting development objectives. And we also looked at the UK as an IEA member country and former net energy exporter. So just very, very briefly, looking at a couple of those subnationals. First of all, on Saudi Arabia, this chart shows that domestic energy consumption is rapidly increasing its share of production. And this is reducing the amount of oil available for export. Now, Saudi Arabia's other massive fuel reserve is its energy efficiency potential, and the government is increasingly looking to efficiency to ease the strain of development, for example, by introducing new vehicle and air conditioning standards. Taking the efficiency standards on air conditioners, these are poised to improve efficiency by 35% by 2020, and this would save around 47 million barrels of oil and potentially increase export revenues by $2.4 billion. Interestingly, if those standards were raised to the level seen in the EU, this would further boost those export revenues by around 50%. Finally, turning to Seoul amongst our subnationals, Seoul provides an interesting example of the concept of energy efficiency as a fuel, with efficiency positioned as directly replacing a supply-side option, in this case nuclear. So the one less nuclear plant plan aimed to raise the city's electricity independence through a number of measures, most importantly efficiency, but also some energy conservation measures and renewables, and saving 2 million tonnes of oil equivalent in the process. On the efficiency side, they have a residential and commercial building scheme with low interest loans for as much as $2 million on the commercial side. The other key area for efficiency has been on lighting, with the plan being to replace 2.2 million street lights and lamps in public spaces. So this is a real case of LEDs substituting the nuclear power. So we're reaching the end of our presentation, and just to briefly summarise. So firstly, this report highlights the changes that have been taking place in the energy efficiency market. It sets out the increasing size of the buildings efficiency market, the disruptive effect that energy efficiency is having on electricity markets, and some of the wider benefits that are leading different jurisdictions to ramp up energy efficiency action. Secondly, while recognising the challenge presented by lower fuel prices in some markets, the fact that countries are announcing new policies that support efficiency leads us to conclude that the outlook for the global efficiency market is positive. But finally, as we move towards COP21 in Paris this year, we recognise that the growth we are expecting to see in the buildings market, for example, is not enough to put the world on track to 2 degrees. So the outlook is positive, but more needs to be done. And with that, I will hand over to our participants for questions, which myself and the team would be more than happy to answer. Thank you very much.
Thank you very much, Sam, and thank you for all the listeners. The presentation will be available on the IEA's YouTube website by the end of the week, and we'll send you a link to that. Please feel free to share with your colleagues. It has been a real pleasure for us to conduct this webinar with you, and we hope you found it useful. We will now take questions. So let's start with the first one. How does this report fit into the IEA's work on COP21?
Thank you, Sarah. I'll take that one and maybe hand over to my colleagues if they want to add anything. I think this report neatly complements the work of the IEA that the IEA is traditionally known for, which is building scenarios looking forward to meeting particular targets, whether those be climate change or elsewhere. So as Kamal pointed out, energy efficiency has got a massive role to play looking forward. But if we look backwards, as this report does, we can see the really important gains that energy efficiency has made over the last 25 years, and is actually, without those efficiency gains, we can show that meeting 2 degrees would be much, much more difficult. So I think it really neatly complements some of that forward-looking scenario work, and can show that energy efficiency has been delivering, even though in many ways it appears to be invisible.
So I would just like to add that the recommendations from the IEA as far as the bridge scenario indicate that energy efficiency going forward could represent 50% of the savings that are required to be on a sustainable path. The estimates for investments that are given in this report are very much indicative of what has been done, but also in the future we need to double the investment in energy efficiency. The second thing that has been highlighted in the IEA special report for the COP is that we need to do a good tracking of the investments and the impacts, and that there should be a periodical revision of those results and new objectives.
Just one other thing to add to that, Kamal, thank you, is just to say that as we move towards COP21, one of the things that is important is that this report, as you might just see at the bottom of this slide, is available for free, which is unlike a lot of our other reports here at the IEA. So we really do think it's important that we get out the messages on energy efficiency, and hopefully one way will be by allowing people to download this report for free. So it's available as of now, as of this webinar, so do feel free to click on that link and download it.
Thank you very much, Sam and Kamel. The next question, can you go into more detail on how you calculated avoided imports from energy efficiency? Tyler, please.
We calculated avoided imports by first breaking down energy efficiency savings into their fuel shares per sector. So we do a decomposition in all IEA countries by sector and then look at the annual fuel share. For electricity, we then look at the country's share of primary energy generation and assume that any additional energy generation required from energy efficiency would have required imports to the share of how much primary energy was burned in the electricity sector based on an import share. So if a country was importing half of its coal, then we would assume that half of the coal generation would have been imported. We figure that this is a conservative estimate, actually, on how much avoided imports were being avoided from energy efficiency.
Thank you, Tyler. Next question. On slide 14, you showed the total primary energy supply generated by energy efficiency in IEA member countries. Can you show that kind of data in non-member countries? And if not, why not? Sam?
Thank you. That's a good question. We send out questionnaires to our member countries, who send us back detailed end-use activity data that enables us to match energy consumption with particular end uses. So that might be hot water heating or space heating or passenger transport, freight transport, for example, by individual modes. And so that data is very detailed, and our IEA member countries produce that. Now, data are available in some non-member countries, but not on such a systematic basis. However, we are looking, as we go forward, to build bridges, more and more bridges with our non-member countries. And in fact, one of the ways we've been doing that is through our Energy Efficiency in Emerging Economies program, which has been running now for the last 18 months to 2 years. And through that program, we are looking to collect more end-use data that should allow us to do bespoke work with those countries on decomposing their energy use, and having decomposed that energy use, to then start doing the type of analysis that we've showed in our presentation today and that you can find in the report if you download it.
Thank you, Sam. The next question. Seoul is a good example of putting the energy efficiency first principle into action. Reducing demand so that infrastructure can be avoided or decommissioned. Are there other such examples of putting the energy efficiency first principle? Are there any other examples known to the team that you could share with us?
Well, I don't have a comprehensive knowledge of all of the programs going on around the world, but based on what's in the Market Report 2015, we've noticed a number of jurisdictions, in particular subnational jurisdictions, which are much more sensitive in many ways to the multiple benefits of avoided energy consumption from energy efficiency. So one example would be one of the leading states in the United States is Massachusetts. Massachusetts was able to reduce its energy consumption by 10% over the past decade, which is significant. They did this, though, by enabling markets for energy efficiency, spending close to $1 billion to enable energy efficiency programming. So while not as explicit as Seoul in naming their efficiency programs to avoid energy nuclear generation, jurisdictions such as Seoul, Paris, and Tokyo are basically doing these programs in that vein.
One thing just to add to that, Tyler, is that it's interesting to note that in the most recent communications from the European Commission, they describe they describe energy efficiency first is the way they put the action that they're taking in the European Union on energy efficiency. And you know, we think that's actually a direct example of the influence of our previous market reports on policy going forward in some of the key jurisdictions around the world.
Well, thank you everyone for participating in this webinar today. As Sam mentioned, the report is free on the IEA website. And if you have any other questions following this meeting, please feel free to email us. Thank you. With that, the webinar is over.